Despite falling recently, oil inventories remain stubbornly above their 5-year average. But in its recent monthly report, the IEA confirmed that demand growth accelerated to 1.5 million barrels of oil per day in the second quarter of this year from 1 million in Q1. Well, looking at this now in the context of OPEC's output cuts and the recent evidence that there may be a pullback in US shale production in the second half of the year. Gaurav Sharma joins us now from International Business Times. Welcome. I want to catch up on the breaking news that you created over the weekend with your interview with Bob Dudley, the chief executive of BP, and the $100 a barrel commentary that he gave. I want to pick up on that in just a minute, but let's take a look at this demand issue here at the moment and work out, with the context of the oil price at $46 for West Texas, as to where demand is going. In your mind, what are going to be the big factors?
I think the biggest demand driver is going to be petrochemicals. This point was stressed last week at the World Petroleum Congress in Istanbul. And I think that the way I view it and the way the EIA and the International Energy Agency and a whole host of others view it is that we should not obsess about automobiles. Let's just look at the wider picture. And I think quite a big demand driver would be petrochemicals, followed by aviation, followed by trucks. And of course, you know, Jeremy, there's this whole discourse about electric vehicles. Now, in 2016, we sold about 2 million electric vehicles. Now, that was just less than 1% of the number of automobiles that hit the streets. So what the EIA is saying is, in the wider context, demand is improving, courtesy of petrochemicals, and that we shouldn't be too spooked about electronic vehicles because that is where the demand drive is. And I think Dr. Fatih Birol, the executive director of the IEA, told the Petroleum Congress that even if 1 in every 2 cars was an electric vehicle, the demand would still grow, because if you look at cosmetics, you look at petrochemicals, you look at plastics, there is a whole host of demand coming from that side of the world.
Geographically, where is the demand coming now? Because I know there's been some shifting in where some countries now source their oil, isn't there? I think you've mentioned India as a good example.
Oh, definitely so. I think India is a very interesting case right now. If you look at the primary demand drivers on a pure crude oil play, I would say India and China lead the way. But out of the big 5, India, US, China, Japan, South Korea, I think India is top of the pile. And I think a very, very interesting development also happened last week was when the Indian minister confirmed that 2 major Indian refiners had actually gone in for US crude oil. Now, at the moment, it's conventional US crude after President Obama lifted the embargo in 2015 and allowed the US to export oil. But the Indian minister confirmed to me that they are not averse to taking US shale oil. And this is a huge event. I cannot, you cannot understate the geopolitical significance of it, because India, the world's 3rd largest consumer of crude oil, if I'm not wrong, is suddenly turning to the United States to meet its short to medium term needs. And this is a country historically reliant on Saudi Arabia and Iran.
And the reason for doing that, is it purely economic, or are there other political fundamentals for this?
I think, to quote a physical trader I'm good friends with in the port of Rotterdam, he says he looks at all his solver models and he doesn't seem to have any problem procuring crude oil at within his price range. So the Indians put it out to tender, got a good response, and lo and behold, they're importing crude at a very competitive price.
Okay, I want to take a look at the US in just a minute in terms of their output. But I want to pick up on this point I mentioned at the top about the EIA and this second quarter demand of 1.5 million barrels a day. The EIA, I think, does say or implies that 1.5 million is not going to continue for the rest of the year.
I very much doubt so. I think the average best that the industry can look at probably about 1.2 to 1.3 million barrels per day. I think that's probably what is on the horizon for 2018. And that's primarily because China is not importing as it used to, certainly not at the 2010, 2011 levels and 2011, 2012 levels. Having said so, Chinese growth, even if it's sub 7% growth, is an aspiration a lot of countries, would give their right arm for. So the Chinese economy is still growing, it's still importing, but it's not like it was 5 years ago.
What about the supply side? I mean, you mentioned the US and the demand there now coming through from India, obviously very significant for a number of different reasons. But I'm also hearing that shale supply, the US supply, is going to drop off later on this year. Is that what you're hearing?
No, it doesn't quite tie into our thinking. I think over the course of 2018, you will see increments in US supply. The city consensus is soon reaching towards 10.3 million barrels per day, which is phenomenal. And which is why, let me bring in what Bob Dudley told us last week was something in the sense that Mr. Dudley said that $100 oil price is an aberration, and that BP, which might interest the viewers of the broadcast if they're shareholders in BP or having a punt on BP, is that BP is preparing for a $1.30 break even. It's at somewhere in the region of $55 to $60 at the moment, and Mr. Dudley wants to halve it. And he says this is not just a long-term ambition, this is a short to medium-term ambition, and BP expects to get there by 2021. Now, BP's boss gives us a flavor of where things are heading. A lot of people, and that's not just him alone, the bosses of ExxonMobil, Total, all seem to be coming around this viewpoint that the prices that we are seeing right now, in Brent's case, say $50 to $60 a barrel, looking ahead to 2018, and in the West Texas's case, $45 to $55 a barrel, this should be the new normal. So this is the range that a lot of people see they'll find very hard to escape, the market find very hard to escape. And the sole reason for that is that no matter what OPEC does, at least till March 2018, at least on paper it's cutting, the moment the West Texas goes north of $45 as it is at the moment, you will see American production getting ramped up. And that is continuing across the board. Now, what happens in March 2018? We have been told that on paper, OPEC would introduce cuts, and apparently, according to Platts, the cuts compliance is about 106%, so they're doing more than they actually promised. But what after March 2018? Does OPEC sacrifice market share? Does OPEC say, all right, well, we've done our bit, and let's start pumping? And then all sorts of permutations come into the window, which is why I believe, and which is why I think probably why Mr. Dudley believes, is that it's a bit hard to escape this range right now.
Right. Let me bring up the price of West Texas, if we can bring up the chart on this. Technically, we've been talking about this. I know our clients are very much into technicals. We've got the price just appearing above this downward trend line here. And some are saying that's significant, but you're saying don't look at the technicals, look at the fundamentals.
I think the technicals and the macro guys have had a bit of a tussle for the last 18 months, and I think that the macro guys in the end, or on balance of things, have won for the simple reason that there is just too much crude oil out there. The inventories might show some semblance of rebalancing towards the end of this year, but there's a whole lot of oil out in storage, whether it's Fujairah or it's Oklahoma or anywhere else in the world, even Singapore for that matter. These inventory levels are way above the sort of 5-year average. I think we want these inventories to sort of come down to somewhere in the region of 2.7. They're at 3.05, which is substantially high. Until that happens, I'm afraid there can be technical breakouts, but I think the overall scheme of things, we're stuck here. So
looking at this chart, whereabouts you going to be happy with this at these sort of levels? You talk about Bob Dudley preparing for the ability to make profits at far lower levels than this point.
I think the way I view it is that if the end of the year we have an average price of Brent $50, that'd be about par. And I think if you have an average price of West Texas of $45, it'd be about par. But I think the averages would be lower than that. We could touch 50 for West Texas. We could touch 60 for Brent in theory, but that'll still not make out for a very poor start to the year.
Yeah. Do you want to follow up with one final question about OPEC and the cuts? We're hearing that Ecuador says it can't sustain these levels. It hasn't got enough money coming into the economy because it relies on oil so much, and it's going to have to pump more than OPEC says it should be. It's an OPEC member. Technically speaking, it's signed up to OPEC's cuts that we saw recently, but it's going to break those. And he's done so publicly. He hasn't done it under the covers, hasn't do it quietly like some countries do. It's come out. Is this significant? Ecuador's not a massive pumper anyway, but is it significant?
I think the symbolism matters, and I think that the atmosphere within OPEC is suddenly turned a little queasy after the Qatari-Saudi tussle, which of course has not impacted their respective stances on the OPEC cuts. Then you have Libya and Nigeria who are exempt from the cuts, but the Kuwaiti minister last week at the Petroleum Congress said, maybe they ought to consider joining the cuts. Now I've got Ecuador saying what they are. And then let's not forget the 10 non-OPEC players who've signed up to this along with OPEC. They're doing their own inventory jiggery-pokery, and even now that doesn't seem to be working because Kazakhstan is now not very much in the favor of saying, well, let's not cut from our existing projects. Only the new projects would be subject to cuts. So there's dissent in the non-OPEC camp and there's dissent in the OPEC camp. Read into it what you will.
Jiggery-pokery, I think it just about sums it up. Gaurav, thanks so much indeed for joining me with analysis there on these markets. That's Gaurav Sharma from International Business Times.